we behave like hypocrites and ostriches in this country. At that time, she was a perfect person.
It's The Biggest You with Stella Madonu on City TV. This and every Saturday at 9 a.m.
Welcome back to The Point of View. We'll be discussing Ghana's financial crisis with Bright Simmons. He's a vice president of Imani. Some say he's a polymath, others say he's simply a genius. We'll find out who he is, but our questions are many. We want to find out what caused the financial crisis. Is it simply corporate greed, incompetence on the part of the regulator, or a mixture of both? What solutions can we bring to bear to make our financial sector work again? Bright Simmons, good evening. Welcome to the show.
Thanks for having me.
A lot of people want to know what kind of person you are. You are a vice president of Imani. But what are you? Are you an activist? Are you a commentator? Are you a journalist? Are you a politician?
I'm publicly spirited.
You're a public spirited individual.
Yes.
A rebel with a cause.
We try.
But how do you pick your issues? I follow you on social media. I notice you sometimes talk about banking, you talk about health, you talk about corruption. What determines what interests you as a person?
If there is opportunity to learn, often if an incident occurs, it's public discussion, but it provides a good opportunity for myself to improve the understanding of the country we live in. As an activist, I am an activist. I do consider myself an activist, but you cannot be an activist if your contributions cannot lead to improvements. And the only way your contributions can lead to improvements is if you understand situations well enough that you are fairly vigilant to the role of vested interest in our society. A lot of people make the point that, we have academic institutions, this can be their research institutions, and we should just let them do their work. What people don't realize is that every establishment at some point becomes incestuous. And if activists are going to hold people to account, then we cannot make assumptions that whether it's academics, whether it's people in the research institutions and the rest, are always out for the best interest of society. So activists themselves have to get better at understanding the situation that confronts the country at any particular moment. And I've just found this whole policy activism space as a very powerful context within which activists can enhance the contributions that they make to this country. And I've invested quite a significant amount of time and effort into becoming a much more effective advocate for the positions that we hold as activists. I think knowledge and activism have to be very interconnected if we're going to be more effective in the kind of solutions that we propose and the rest of it. Yeah.
I was fascinated to find out that I was on a plane from South Africa a few days ago on the 9th of August, and I recall that 2007 August 9 was the day French bank BNP Paribas said that it could not meet some of its obligations. A few years after that, a few other banks had challenges, Northern Rock, and then it went to the US, Lehman Brothers, etc. So this was August 2007. 10 years later, August 2017, two banks in Ghana, UT and Capital Bank, essentially collapsed. And then a year after that, 5 more banks collapsed, merged into one. First question, what has surprised you most about Ghana's recent financial crisis?
I was quite surprised by the scale of Unibank's penetration to the Ghanaian economy. The amount of money that was being discussed at that time was quite substantial. So we are talking of a bank that at one point had liabilities in the range of $1.6 billion thereabout. This is an economy of $45 billion. So it gave me an indication. I knew it was the 5th largest bank, but I hadn't paid attention to the amount of influence that they had built in the financial sector. That was one. The second more critical issue was the extent of non-performing assets. The Bank of Ghana said in excess of 80% of essentially the loans they have given out were not going to be repaid, or they were at a very high risk of not being repaid. That is substantial. It means, therefore, that of every bet they took in the market, the Ghanaian market, more than 8 of every 10 bets that they took in the Ghanaian market, more than 8 did not pay off. You know, either it was a case of extreme misfortune or extreme recklessness. It's very difficult to tell without more information. And the scale of the losses are completely mind-boggling.
Yeah.
And I found the inability of the central bank to act at various points as this problem, you know, continued to build and deteriorated, quite surprising as well. So I'll say those 3 things are the things that stood out.
So the size of Unibank, the scale of their mistakes they made, and then the fact that the Bank of Ghana could not predict or control or prevent were 3 key things for you.
Indeed, and what was more interesting was what they said about the Ghanaian economy and the society in which that economy is embedded. So is it that the situation on the situation in the economy is so bad that banks, when they make a bet, when they make a particular commercial bet on a particular asset class or a particular opportunity, simply miscalculate to the point where these losses are purely a matter of poor risk management? Or are we really looking at the beginning of a potential real economy crisis itself? It could be a very chronic crisis such that, because our economy is not very sensitive to data flows, even if there was a real economic crisis that was bubbling underneath, we may not feel it completely because we are used to these wild swings in currency currency pricing, wild swings in inflation and things like that, so that there could be a real chronic crisis which will be leading to serious social consequences like unemployment and things like that, without all of it being very obvious. So I wondered what it meant as a stroke into the economy.
We'll come to that, but I'm surprised that you are not surprised about other things. So the Unibank one was surprising. The other points, you weren't surprised about UT. You weren't surprised that because I looked at UT's shareholders.
Yes.
I saw IFC,
yes.
10.4%.
Yes.
And there were other significant international shareholders.
Yes.
So UT should have been surprising.
Well, the scale of the UT collapse is almost insignificant compared to Unibank.
In terms of the size.
The size of it. So it's very possible that with a few miscalculations, the whole UT empire, at least the banking part of it, could crumble. Some of the loans that they had made to engineers and planners and the rest were a substantial part of their entire loan book. So though UT was surprising, it wasn't that surprising for that reason. The second reason is also that word does get around. And for a long time, there were market that UT was having challenges. Then also it reflected somewhat the reporting history of UT. If you look at the way that they've reported over a number of years, it was quite clear that performance was not at its peak. Whereas with the Unibank, and that is why later the assertion that there were some misreporting to the central bank, and that could also be blamed for the level of opacity, made sense, because it was quite unclear to me as an outsider looking in that this was the depth to which the problem had descended.
We just put the shareholders factor of UT on the screen, and it's incredible. You have UT Holdings 42%, Duet Africa 4%, International Finance Corporation 10%, Africa Fund 1.9%, Investec. You're looking at single obligor limits being exceeded. You've seen a lot of breaches. Aren't you shocked that international agencies are part of the ownership, presumably the board, and yet they could oversee such a cataclysmic fall?
Yes, to the extent that risk management failed, if you have a very strong risk management system in place, it presupposes that you don't expose, the entire bank to some of the degrees of exposure that we saw, appropriate for the kind of risk that they were facing. And it's quite surprising that if the boards were properly constituted, we do know that there was some degree of laxity as far as board subcommittees were concerned for risk, for audit, etc. There are reports of certain subcommittees not meeting consistently for a number of quarters. So and that is why I'm also concerned that we don't have the official reports of receivers and administrators in the public domain.
And we are dealing with snipers.
We're dealing with snipers.
Which is very sad.
I find that quite frustrating.
To my mind, there are two main reasons, or two groups. There's one group where people did what is called related party transactions.
Yeah.
Unibank, a lot of that. Royal Bank, a bit of that. And then you have just improper capitalization. That's beige, sovereign, construction. So those are the two broad groups. But are there any other similarities when you put the 7 banks together? Since you are such a, I don't know, you like observing patterns, is there any other thing that runs through the 7 banks or the financial system that you should say these are uniquely Ghanaian ways of banking that have led to this situation?
Obviously, some of the banks that have not been affected by this particular trauma are either banks with very long pedigree. So you have a lot of banks like Barclays, and some of them dating back, hundreds of years. Then you have banks that are multinational banks, and multinational banks generally will tend to have more cushions just because they have diversified risk across geographies. So the banks that have all their risk concentrated in one location typically will have greater difficulty in terms of the risk profile that they present to investors and the rest of it. So generally, the fact that you are a local bank alone will be somewhat put you at a certain degree of disadvantage compared to banks that have diversified geographical focus, as an example. So that was obviously an issue. But I think we also have incidents where the majority of banks that are really very new banks. So some banks that are a year and a half old or something like that. We have banks that have been operating as tier 1 banks or universal banks for less than a decade. So inexperience probably has been one issue. Culture, because when you've just built something from scratch, these are startup banks, and startups everywhere are very risky. So the fact of the matter is that, truthfully, young companies die almost by default, to a larger degree than older companies. We say that 70% or so of all startups. So generally, the risks are amplified if you're a young bank. What that means, obviously, is that there may be a need for regulation to recognize the fact that some banks may be less experienced and therefore require more handholding. There may be a need for that. I'm not sure. I've not really thought through it very carefully, but it's quite clear that the younger banks tend to face more stress. They tend to have weaker cultures. It's also possible that their cost of, and it's quite, so people say, why didn't some of these banks stay on as savings and loans? That's because they don't really understand the way that this is, the whole ecosystem is set up. Cost of funds for non-tier 1 banks is very high because there are very few call deposits. So if you look at Beige, number one strategy for many years, or at least for the number of years that their reports cover, was to increase call deposits as opposed to term deposits. Because if you think of it, when you put your money in a traditional bank in Ghana, and you get yourself a checking account, you often are paying them to keep your money. You are suffering the effects of inflation alone, and then thirdly, they are lending your money. So if you have, every time you have positive balance, this is money that you are putting to work for free, right? That is way cheaper than the term deposits that some of these banks and savings and loans are confronted with, where in some instances they are paying up to 30% to the people that are giving them these, this capital to work with. So the cost of funds problem is huge for young banks. Why? Because they haven't spent years building their market brand. People like yourself perhaps do not have your bank accounts there. It's possible that if we did a survey of this room, the majority have their bank accounts in the so-called traditional, banks. This is very cheap capital for them. That's one dimension. The second dimension is just sheer penetration. So who has all the blue chip accounts, for instance? The third one is, then people don't often realize this, is if you have an economy where increasingly a large part of the economy is dominated by multinational companies, by expatriates, etc., the other components of the system also begin to reflect it.
Okay.
So if, for instance, you have a multinational business in Ghana, are they more likely to bank with Barclays or with a young 5-year-old Ghanaian bank? So all in that, the younger you are, the less pedigree you have, the more heightened all the risks that confront you are. And that therefore means that we need to have a more discriminatory.
But if you look at our history, in the 80s there was a financial crisis.
Yes.
There were bank collapses. There was another one. And now we've had another one. So if bank collapses, should we be concerned that Ghana's financial system is inherently problematic, looking at the fact that every decade you have something like this? Or so how do you assess this recent crisis if you put it in the context of history?
I mean, we had a meltdown in the 80s. I mean, by 83, we had a serious economic meltdown. And when we went the way of SAP and we introduced FinSap, where some of the first things we had to do was completely clean up the banking system. Okay. So what you are talking about is somewhere around 88, when we had the very elaborate reform of the entire architecture of the banking system, and then we issued the FinSap bonds. I'll do some calculations to find out the cost to us then, and it depends on how you measure it. I mean, if you just look at just historic value of money, it's like at that time I think it's about $300 million, and you just look at the historic value of money, it's probably maybe $700 million today. But if you look at the relative proportion in terms of banking assets involved, in terms of GDP. So if you do a more sophisticated analysis to try and figure out the scale, then and today it's way more than we spent today. It's about $2.7 billion.
At the time.
If you look at the relative impact of that $300 million, taking a more sophisticated range of measures, we spent about $2.7 billion comparatively to what we are spending
in 87, 88.
Around 87, 88. And then it continued till around 91 when INPATS, the non-performing assets recovery trust, became a thing, so to speak. And then the problem that has happened, or rather the pattern that has emerged, is that we often have these crises happen in a particular era, and then we move into another era, and when radical changes happen, we seem to assume that by the very nature of the transition, these things don't matter anymore. So we are moving from military rule into democratic rule, and a lot of from my understanding of INPATS, which is the fund that was set up to try and recover the assets, we didn't do a very good job at it. I'm still doing my computations, but it does appear, and if history anything, it does appear that a lot of the loans that were not paid back, and the private sector loans that were not paid back, public sector that were not paid back, were still never recovered.
Okay.
And then in the mid to late 90s, as you rightly pointed out, we had another incident where a few banks collapsed. Here too, it was single obligor limit issues, and there again, you are right. It doesn't show a particularly problematic trend compared to Kenya, compared to Nigeria, compared to even some of the so-called advanced economies. The truth, though, is that we have projected our financial sector as very robust. Profits were surging. I don't know if you recall, but every year profits had to, exceed the year before, the performance the year before, and so this came as somewhat of a shock because the scale of it. The number of banks involved, the fact that in some instances we're talking about negative 280% of capital. This is just crazy things. Also, I think there is a greater sense among at least the general population that complicity is not only adverse, it's not only quite shocking, but it's very deep. There's a sense that even the Bank of Ghana was compromised. There's a sense that in some instances you have malfeasance. I think this has compounded it. I mean, in the 80s, it was clear that the majority of the problems were purely real economy problems that spilled over into the financial sector. In the 90s, you had very specific banks, almost a specific incident. This time around, there is a sense of general impunity, disregard for banking regulations and laws to a degree that did not, to my mind, prevail in the 90s and in the 80s as far as those particular crises were concerned.
So even in an era where bankers' reputations have gone down, this is serious.
Well, they've gone down globally, but in Ghana, it was a counter-cyclical. In Ghana, the banking sector was seen as very respected. Bankers were, always at the very top of the echelon, the pecking order as far as reputation is concerned. So we don't have the same suspicion of bankers that they do globally. And also, the banking sector was performing, the financial sector as a whole has been growing dramatically and was performing, at least we're told that it was performing astoundingly well. So this sudden collapse, I think...
Are you surprised about the linkages between the banks? So if you look at, for example, UT Bank's loan book, Beige is in there, Engineers and Planners is in there, right? If you come into Capital, then you see Sovereign. Okay, there's all kinds of incestuous interlinkages. Is that unique to our situation, or this is normal?
No, this is very standard. I mean, the London Interbank offered rate, the LIBOR, it's itself generated out of interbank transactions. Typically, banks do several transactions with each other, and in more integrated economies, it's actually worse because, and I presume you're going to go down that route. But on the whole, we have a very simple financial sector. We don't have any of the exotic products. We don't have any of the
derivatives and those things.
Derivatives, securitization. Any of those very complex to analyze instruments that elsewhere actually provides the complexity that makes.
We don't have that. I'll come to Men's Bank, which is a different opportunity. But let's talk about the Bank of Ghana.
Yeah.
They did an asset quality review.
Yeah.
They found out that a lot of the banks are not well capitalized. And then, of course, they decided to increase the minimum capital requirement. Everybody has to produce $400 million, which has led to a lot of controversy. How do you assess the Bank of Ghana's role in all of this?
So obviously, we have to distinguish between the regime that just prevailed and the current regime, because it's quite clear that this current regime has been willing to push up enforcement. So we need to separate the issue of enforcement, of clear rules, but particularly in relation to risk minimization. So essentially, where it comes to taking strong action to prevent contagion, this current bank regime, regime at the Bank of Ghana, cannot be faulted. They've acted very strongly to prevent contagion. Where it comes to general management of the sector, and particularly, to my mind, the intellectual foundation of some of the policies, I don't see much of a difference in the way that they are thinking. Seems to be shaping up. So
the intellectual foundation.
Yes, I mean the way that.
Okay, let's make it simple.
Yeah.
The Bank of Ghana says there is systemic risk. A lot of the banks are not well capitalized. So our major policy is what? Raise your minimum capital. We want a capital cushion. Because whether it's liquidity or insolvency, it leads to risk. And a capital cushion addresses that. What is wrong with that policy?
So that obviously should be coupled with the whole, to my mind, obsession about Basel II and Basel III and the Basel Accords in our particular context. First of all, there is absolutely no evidence that paid up capital is a very important determinant of bank stability or bank financial health anywhere in the world. And if you have the literature, you can send it to me. Capital adequacy is something else entirely. Capital adequacy is very simple. You've given a good chunk of the loans is depositor money. We amplify that risk by about 3 times to see the systemic risk to the rest of the overall macroprudential environment. Based on that judgment, we want you to have some capital yourself, that is not other people's money, that you can fall upon if there are any problems with the money that you've lent out coming back to you. That really is what we are talking about.
Yes.
A bank's fundamental mandate is to take money from savers and give it to investors. That's a bank's fundamental rule.
Yes.
Having additional paid up capital or equity is there, like you rightly pointed out, to serve as a cushion if that process, that intermediating process, doesn't work very well, right? If things are working well, you probably don't even need your own equity in a particular region of the framing of the subject. Now, when you say, oh, okay, I think that every bank should have 400 million cedis, minimum capital. Let's actually use $90 million because it's easier for me to just process. That's minimum capital, paid up capital. You, the people forming the bank yourselves, you have $90 million to put up. And then we all know that in Ghana right now, we have about a 10% capital adequacy ratio, right?
Yes.
So if we are just being naive, we can just multiply the 400 million by 10 or the 90 million by 10. And so we expect that your total assets value is around $900 million. These are the loans and advances you've given, right? That scale is all you've talked about. It has nothing to do with the actual quality of that intermediation process, that's one, or the actual risks that you are facing. If I decide to lend only 100 million, because these are that's the part of the market I understand, let's say the SME market, I cannot really inject more than 100 million. That's what I can do. Then it means, I'm using very crude terms here, $10 million of capital is compliant, right?
It's enough.
Now the question is, why can I not have that strategy? Because the Bank of Ghana says we should have big banks. The whole policy around minimum capitalization is simply the Bank of Ghana just decided that Ghana needs big banks. The minimum size of a bank in Ghana should be around $1 billion. Really, that's what it's about.
So you're saying we should separate the amount of capital from the calculation of capital adequacy?
No, not a calculation. I'm saying that capital adequacy as a concept is about how much loans let's make it very simple, how much loans you've given. And how much of your own money do you have to support in case those loans don't come back?
Good.
And then depositors whose money you've used to give out the loans want their money.
But if I say, so increase the amount of your own money that you put aside.
Good. Then the
To
question is
cushion
that,
against whatever loan you will give.
no, but you can't do that because then you increase the cost of operations. You can't say that, okay, we want 30% capital adequacy. So if you give out 300 million, you want 100 million there. Because then my cost, because I'm keeping 100 million that I'm not earning money on. Are you getting the
So it
problem?
makes it more expensive for me to run a bank.
Good, and it therefore makes me more likely that I'm going to charge more.
But they are saying
So
that.
you have to. So it's a trade-off between not expecting people to keep so much money sitting there.
But I get it. But if for example, some companies like UT, they give loans to the extent of excess percentage of amount of money they had to cover it, and we have to pay for it. So the government is saying, "I'm going to borrow money to essentially pay for your bad debt, so that your business doesn't collapse." If it's you had your own money as something you put aside, and a lot of it, and this is a very common thing.
No, but the liabilities that has been exposed clearly show us that a 10% capital adequacy, even if that was indeed the case, confronted with 80% impairment of assets, the loans that will be going out, 80% not coming back.
It will still not
It
work.
will still overwhelm your
So you don't think?
So my
you
point
don't
is that
think
it has no link
so
whatsoever.
the strategy you don't think is grounded.
It's not grounded by comparative analysis.
So is that final? No problem. If you were the governor, what would you do?
Well, but first, let me make the point that there are a lot of countries around the world which confront similar problems and those that confront more sophisticated problems. And we have a very good idea of what the range of capital in most markets are.
All right.
If you take a country like India, much more sophisticated, much more complicated, huge amount of, several multiples of our risk exposures in various domains. India has about a $77 million requirement, minimum paid up capital requirement. We are trying to go to $90 million. This is higher than Nigeria as well. This is several times that of Kenya. In fact, attempts to increase minimal capitalization often run into resistance by Parliament. It tells you that in other places, people really do raise the pros and cons of these policies. You go to a place like Switzerland, it's about $10 million.
Could it not be that the Bank of Ghana thinks it's too easy to set up a bank in Ghana, and that every Tom, Dick and Harry wants to own a bank? So if you raise the bar, only serious and people who have depth would own banks. By doing so, they'll reduce the number of banks, forcing mergers.
Yeah, but you issue the licenses, right? So if the fact that the minimum capital requirement is $10 million doesn't mean that if anybody shows up with $10 million, you give them a license, right? You are supposed to scrutinize the business plan. People always forget that part. So there's an element in which Bank of Ghana assesses not merely credit risk, but also operational risk and market risk. And if you look at the Basel framework, including the current directive that the Bank of Ghana has issued just a few months ago, I think June or whatever, and which is supposed to come into place, I think, next. Look at it quite clearly. In the Basel framework, risk assessment is not limited to just credit. So you have to look at the business plan that is presented and see, because it's a highly regulated industry. And if somebody comes to you and says, look, I want to get a bank license, and here is how I propose, in a very competitive landscape, to make return and contribute to the economy, you need to be able to do an assessment that is comprehensive enough. So what is that? So just simply say, to give an example, Unibank was not necessarily undercapitalized in that sense. The scale of those we've seen, it was not undercapitalized. That was not the real problem.
Good.
And we've seen none of the banks, apart from I think in the case of sovereign or construction, necessarily had capitalization issues in the way that it's been.
No problem.
So capital adequacy is a very different problem.
We'll take a short break, and when we come back,
the problem they had capital adequacy.
When we come back, we'll talk more about Capital Bank, and we'll look at men's gold as well, because it's something that Bright has been talking about. Initially, you wrote an article about this a year ago, and it's still a big problem. But let me read a few comments on the subject of the banking sector. The supervisory department of the Bank of Ghana, as well as the managers and directors of these defunct banks, should be held liable to give a thorough account of their stewardship. These are white-collar crimes committed by white-shirted individuals whose intentions are to defraud the system. This is from Kofi Seidu. Bernard, good evening. Please, what will happen to the staff of these banks after 60 days, especially those in the low ranks? It's not any problem of theirs that the banks collapse. You don't add your name. I am Wayne Avise from Dansuman. I think it's lack of supervision, evaluation, and risk management of the day-to-day activities of these banks that led to their collapse. Good evening, Bernard. Pastor Otabill's statement was unfortunate. What was he doing there? Was he there to help the bank to function well, or was he there to help the bank to collapse? This is coming from Insawam. I'm not sure if you know of Otabil State. We'll take a short break. When we come back, we'll go more into the issues. This is the point of view. My guest is Bright Simmons. Don't go away.
It's engaging, detailed, and loaded with factual and incisive analysis. It's The Big Issue, your preferred Saturday morning news and current affairs analysis program on City TV. Tune in this and every Saturday at 9 a.m. and hear the newsmakers discuss the top issues for the week.
At that time, Charlotte was complete. I'm not defending Charlotte. I'm talking about the way we behave like hypocrites and ostriches in this country. At that time, she was a perfect person.
It's The Big Issue with Stella Madonu on City TV. This and every Saturday at 9 a.m.
For regular news checks as they unfold. 2020 news, all day, all the time. Politics, sports, entertainment, business, and more. 2020 news. We bring the world in 20 minutes.
And that's all the news in 20 minutes.
Welcome back. This is The Point of View. We're live on City TV. We're also live on Facebook. My guest is Bright Simmons. And we're trying to understand what led to the banking collapse. And we're assessing the response of the Bank of Ghana. Are they heroes of villains in this? Bright Simmons says we should separate the previous BOG administration from the current administration. He endorses the enforcement, but does not think that their policy of increasing the minimum capital requirement is intellectually grounded. Let's talk about Men's Gold. They've come up in very interesting. A couple of days ago, when the 5 banks collapsed, the CEO of Men's Gold put up a tweet, essentially saying that the Bank of Ghana should leave them alone and focus on the bank collapses. Of course, yesterday he apologized and he says man is fallible. It appears the running battle between that company and the regulators has not ended. I'm going to play you a short report we put together, and I'll ask Bright Simmons' views on that and tie it in with the banking situation. So this is Nana Oye's Anchorage report on that company.
The Bank of Ghana's warning may have received some wide circulation, but may not be the tool to deter people from doing business with Men's Gold Ghana. This is because the premises of the company's headquarters at Jowolo here in Accra was today packed with lots of vehicles. Despite this morning's rains, dozens of customers were to do business with the company. Officials on duty who will not speak on camera said business was as usual. Customers were all seated counted for their turns to be served. Most of them who spoke to me said they were there to collect the returns on their investments.
Yes, I've come my dividend. The month has due that I've come to fill my form to withdraw my dividend for this month. That's 4 months now, and it has always been successful. So I don't think there is something wrong now, even though we are hearing news outside here and there, Bank of Ghana here and there, but I don't think that has impact on me as a person, because I trust in this company.
No, basically I haven't had any problem with them. I came here to do my usual business, but apparently my business has ended with them. So I'm here for my, I have use for the money for other projects that I want to engage in. So basically that's why I'm coming for the principal, not about the brouhaha that's going on. And as business is going on, people are taking their dividends, and others also have come for their principal money.
Existing customers were not the only people who were seen going through the processes to fill documents. Some were there to invest with the company for the very first time. Andy Brown is one of them.
I came to invest my money. I heard about the men's good, and when I came to they briefed me through, and it's actually good. Someone even sent that message to me on WhatsApp, even pop out on social media, but I don't believe in. I believe I can trust men's good.
The company insists it is operating legally, despite reports it does not have a license to undertake its current operations. There are a series of meetings currently ongoing between lawyers of the company and regulators, including the Minerals Commission, to determine the future of the company. As you can see, it is raining. However, when you enter the men's good offices, the customer service areas are fully packed with customers who have come to do business with the company. It appears they are not perturbed with all the stories going around about the company. For City News, I am Nana Oyankra.
So that was Nana Oyankra's report. A couple of things intrigue me there. So this has been going on for over a year. The Bank of Ghana keeps saying people should not send deposits. They should stop taking deposits. People don't really care. People keep going. First point seems to be regulatory confusion. Is it the Bank of Ghana, the Minerals Commission, or is it possibly even the SEC? How come we've not been able to resolve who is the regulator for this company? Is it because their business model is so sophisticated?
Not really. I mean, I think I was reading something on social media recently, and somebody was talking about regulatory arbitrage. I don't even know how that arises.
Regulatory arbitrage?
Yeah, because typically regulatory arbitrage occurs when the economic valuation of an asset does not coincide with the regulatory valuation of that asset. In this case, we don't have any underpricing or overpricing based on the way regulators have defined something, and the way that the market have defined something. So the regulatory arbitrage argument doesn't even arise. But there are arguments that there is a regulatory gap which the company is exploiting. Two things. One is typically companies pride themselves on having licenses, particularly in finance. You know, it's seen as an asset. If and typically you will see that in most places in the advertising, they will indicate that they are licensed, because that presupposes that somebody else has looked at their books, look at the way that they do their business, and has endorsed the manner of their operation. So what we have here is a very peculiar sociological phenomenon where people actually don't seem to trust authorized institutions as adding value. So if Bank of Ghana and get license, or the SEC and get licenses, and people are still happy dealing with them, then what does it mean? It means that in the society, government institutions from a trust point of view.
But you are going too far. Before we get there,
no, but that's the truth.
What is your understanding of the company's business model?
They say that they buy gold, so that they have gold. Then they sell the gold to people that want to buy gold. But because they are better at trading the gold, they enable people then to leave the gold with them. So basically to loan the gold back to them. And then for the fact that you've loaned the gold to them, they will do trading with the gold, and then share the returns on the gold trading. There is no confusion in terms of what it is that they are doing. That is purely a fixed income play.
So I have gold as men's gold. You come and buy the gold from me.
Yeah.
But because
I think it says it's a subsidiary that you buy the gold from.
And then the company then, because they understand the way gold works, will trade the gold on your behalf and give you a certain
fixed return. Yeah.
Down the return is at least 10%.
Yeah, so we've heard different numbers. Some said 7%, some said between 7 and 10%.
But if you look at the way gold prices are behaving on the world market, how is it possible to get that kind of return per month on a commodity that is globally, the prices have been falling?
Well, that's their proprietary trading algorithm, or whatever it is that they claim that they have.
Algorithm?
Well, it's proprietary to them, so they're not bound to disclose that to anybody, including regulators, into exactly what systems that they have that give them those returns. What they are not at liberty to do, though, is to claim that what they are doing is not a security. What they are offering is a security. If I go there and I give you the gold, and you assure me by a contract that you're going to give me a certain percentage of this contract,
but they are not. But you see, the Bank of Ghana said stop taking deposits. They say we are not taking deposits. We are selling. Okay, we are buying gold from people and selling it on their behalf and giving them a return. So that's a security.
There are three problems with that. The first problem with that is that because gold, by its very nature, is hard for ordinary people to assay. If I come to you and I claim you give me gold, and it's just a aluminium with some yellow thing plated on it, I can't tell whether it's gold or not. Which is why we have a national laboratory, the PMC, which assays gold. It finds out whether this is really gold or not and say this is 24 karat or 23 karat or whatever it is, that 22 karat or 24 karat or whatever. So how do normal consumers actually determine the purity of the gold?
Whether what is real gold?
You can't,
point one.
right? So that is why, from a consumer protection point of view, from a market standards point of view, there has to be some kind of either a regulator, a quasi-regulator in that space to make sure that you are selling real gold. So that is why the PMC is there. So you do need, if you are going to be trading gold in this country, and you want to assure the buying public that the gold is of the right quality, it makes sense that you typically will go to PMC for certification. So that's one. Two, if I buy the gold from you and you intend to invest the gold on my behalf, then you're an advisor. You are an advisor, you're a financial advisor. Secondly, you're also a broker. Because in this particular instance, it's not actually Men's Gold that owns the gold. You bring the gold from somewhere and then you deposit it with us. So Men's Gold is offering a vault service, in that they claim they are storing your gold for you. But on top of that, they are investing the gold on your behalf. So that makes them a financial advisor. You have delegated, because you could have gone and kept the gold or done whatever it is that you want to do with the gold for it to appreciate in value. But if you've delegated that responsibility to Men's Gold, that means that Men's Gold is offering a financial advisory and an investment advisory service of some kind. And that's purely regulated by the SEC.
So this is the SEC?
It's purely the SEC. The problem that arose is that
Securities and Exchange Commission.
Yes, the Bank of Ghana seems to want to position itself as some kind of octopus agency across the financial services sector. And therefore, rather than sit down with the SEC and go like, you guys have to go public, you guys have to talk to these people, they will issue these confusing statements which suggest that they are impotent to act. But at the same time, they are traumatizing people that are investing in these instruments. Now, the question that arises is, from a consumer protection point of view, all these people that have already gone and put money into Men's Gold, they also do deserve some protection, given the nature of the situation. Because the Bank of Ghana and all the other regulators, in their confusion and in their lack of clear communication.
The Bank of Ghana has been clear. They said the company should stop taking deposits.
And they said they're not taking deposits, right?
So if you take your money there and your money gets lost, why should you be protected?
No, but if it's not a bank, then on what basis your money going to be protected? It's not a bank.
That's my point. So
and even with banks, we don't really have deposit insurance already activated yet, in some funny kind of way. So in a lot of ways, the protection of deposits that we operating is an ad hoc system.
So you think the Bank of Ghana is overstepping its bounds?
In this case, it complicated the issue, because coming out and saying that it's not a bank, but we think it's taking deposits, and somehow we can't stop them, confuses people. Or aren't you confused yourself?
So it should have simply been the Securities and Exchange Commission,
Bank of Ghana,
interpreting what they are doing as offering some sort of instrument which qualifies to be regulated by the SEC.
Indeed, because what they are offering is a security. In some ways, it even appears to be a derivative, because it's tied to the price of gold. The only problem is that they don't explicitly say that.
A derivative?
They don't explicitly say that, this particular asset is tied to a particular index. So it's hard to say, I say it's a derivative. But it looks like that. And it's also fixed income, because you are assured of a specific return. They don't share the risks. Even if they have gone and said, look, guys, we want to create a linkage between you and some gold exchange overseas, and we take fees. That will be slightly different from a situation where they say, no, we take the gold that you've loaned to us, we sell the gold, buy it back in some form at a profit, and then share the returns with you. That is actually investment advisory, in the sense that you've delegated the risk, which then makes it very important that they have their disclosures. Secondly, if consumers are bearing no risk, in essence, it presupposes that somehow the risk is being managed. So you must have some capital cushion. But what if the price of gold falls? Unless you are saying that you have a mechanism to generate return without risk, which is known worldwide to be financially impossible. So there must be risk. And if it's risk, then there's possibility that somebody may lose their money. And if there's a possibility that somebody may lose their money, then in essence you have delegated that risk to you. Then there has to be some regulation that subjects you to the proper test.
Interesting. In the past few days, there have been two developments. We've cited a memo of some kind, cabinet memo, that has investigated this whole thing and seems to suggest that the Men's Gold and a brew are related companies. But we don't know what specific action will be taken. Also within this week, the CEO has apologized to the Bank of Ghana for his disparaging tweets. So it appears they've smoked the peace pipe, at least for now. What's your prediction of what's going to happen?
I mean, the government regulators, the regulatory agencies and the government have to be wary of taking steps which endanger people that have invested. Because if at the end of the day you take steps which endanger people that have invested, then what was the point of intervening in the first place? Is it actually for the sake of these people? Unless Men's Gold somehow poses a systemic risk to the banking sector, which I can't fathom. I can't see how they pose any kind of...
So should the government leave them alone?
No. They have to be given a period of time to regularize by registration with SEC. What they are doing is offering a security.
So SEC should regulate them?
They have to be regulated. They have to be given a period of time, during which period they need to submit the requisite documents to the SEC, which will at the same time then impose on them requirements around disclosure. You have to tell people if there are risks. Is there a risk of losing your money or not? That's often a very cardinal part of the disclosure requirements. They have to obviously submit regular returns, and their accounts and the rest of it have to be audited to ensure that the disclosure that they've made to the regulator are sound and proper. So I don't see any way that they could continue to claim that somehow what they are doing is so complicated that we don't have laws to do with it. We actually have a lot of laws to do with what they are doing, because it's actually very plain vanilla. Secondly, there's an interesting point around the fact that they kept talking about Minerals Commission because they have a bulk license to export, and they said that the fact that they have a bulk license to export automatically allows them to sell gold to the general public, keep the gold, invest the gold on behalf of the general public. I don't know who advised them to make those extrapolations. At the very least, if indeed all it was about gold, if indeed it was a commodity trade that they were doing, then they don't even need to hold the gold. Because there are a lot of gold indices around the world, gold traded exchange funds, and so the fact that they found out that they have to hold the gold and export gold and the rest of it means that they have multiple business lines, one of which could well enough indeed be covered by the Minerals Commission. That's why the export side of them. And what I'm told is that they export millions of dollars of gold in Ghana. So they have some weight. It's not a light organization in that sense. If they're exporting millions of dollars of gold from Ghana, by some reckoning, more than $50 million per quarter, it's a huge company in essence. So I think the regulation their status should be regularized, and government has to be wary in the way that it proceeds, because it may end up endangering investors.
Let's read some comments for you, and then we'll come back to the banking sector. Ahmed Salim Bongo in Medina says most CEOs hide financial records from boards, and I think this is what happened at some of the banks. Also, some big men accept to be board members of companies that they have less knowledge of. As a board member, I believe you should have some knowledge about the industry that your company finds itself in. Dela from Wager says, Bernard, most of the banks fail to appreciate the concept and impact of intellectual capital by focusing too much on physical assets like big buildings. Bernard, I'll be glad if your guest breaks down what he's saying to layman standards. Too many terminologies. That's somebody for you. Justice Offair says, hi Bernard, let me thank the erudite innovator of our time, Bryce Simmons, for getting us a rep for the Africa Economic Dialogue 2018. My question, what is his candid view on these in salvaging the confidence of the financial industry? 1, deposit insurance. 2, decentralization of the Bank of Ghana as done by other central banks, for example, the US. More comments. Bernard, I think the SEC should be working with the BOG on this men's gold issue, but it seems you do not have the laws for the kind of business they are undertaking. I also think they are playing some kind of derivative tricks here. You don't mention your name. There are a lot more comments coming in. Now, the Bank of Ghana, in their UT and Capital Bank thing, we've chanced on the boldest advisory, and we noticed 27 steps that the Bank of Ghana had taken. Key steps include directors or shareholders of the collapsed banks, the 3 big ones, or the 3 UT, Capital, and Sovereign, undertaking that for the next 5 years, don't do any financial kind of business. Assets have been seized. There's a clamor for prosecution. But if you look at the caliber of people involved in some of these banks, and you look at Ghana's history with dealing with such things, what is your sense of what's going to happen?
I mean, to the extent that the penalties regime in the various laws empower the Bank of Ghana to exact penalties, it'd be interesting to see whether an attempt to implement some kind of offenders register can be done without sufficient due process to establish the guilt of the people that are being subjected to these new rules. I feel strongly that regulators, government agencies in general in this country are often allowed too much room to make policy without serious contention about the quality of the policy. And I think this is generally a problem that we see in different forms. So when you say that, we have to increase capital adequacy. Sorry, we have to increase minimal capital as a way of stemming, the risks that confront the financial sector. When in fact, every time you've increased these minimal capital rules, your non-performing loans appear to be almost linearly correlated with the increases in these amounts.
In other sense, it's not working.
It's not working because what is happening is if you force people to put a lot of money into banking into Ghana, and there aren't enough favorable assets, so to speak, to invest in, they get risky, and then they look for big ticket items which are even more risky, and then you have a death spiral. So we have to be very careful. You look at a situation where we've moved from our $740,000 in 1989 to $90 million by the end of this year as minimum capital requirement for banks. My fear is that as they continue to push this agenda, banks will need to make substantial returns because of the sheer frustration. They have to go through a lot in order to be able to come together.
So you mean they'll behave in more risky ways?
It's possible. You're going to have an adverse selection where only the riskiest people go into banking.
Really?
It's possible. And then you're going to have a situation where, because already, capital is already very expensive, we are seeing a situation where a lot of people that are borrowing are riskier than average.
Wow.
Because it's very expensive to borrow. So you are not going to borrow, even if you have a great idea and perhaps the entrepreneurial acumen, you're rather going to keep it small. The person who's going to borrow is the person who is very risky and doesn't care. And these things are conflating. So more risky people are borrowing, or more risk, people that are less risk averse are borrowing. And then people that are more risk, how should I put it, more inclined towards risk, they get into banking because the stakes are so high. We need to have sufficient variety of people in the banking system.
Okay, there are a couple of other recommendations. First, today the Bank of Ghana released a statement that said they are establishing a new office called the Office of Ethics and Internal Investigations to strengthen good governance within the bank and to promote the highest standards of ethical conduct commensurate with the bank's mandate. If you look at the Eagle project, there's an admission of failure of the banking supervision department. So they're saying they're going to do some tests for the people who work in the banking supervision department. They will form extra committees to oversee their work. So the Bank of Ghana admits that part of the cause of the problem was weaknesses within the regulation, the regulator itself. How significant is that?
I mean, it's quite obvious that you had weaknesses that cut across not just the banking supervision department, but went to the very top of the Bank of Ghana. It's quite obvious. The reason why I say that is simple. Not all the problems were purely supervisory problems. You had instances where pure basic stress testing will have revealed that some of these banks were under huge stress and strain. You don't have, it's not purely supervisory in the sense of making sure that disclosures are, genuine and stuff like that alone. Just by looking at, bank trends, NPL performance and things like that, you should already know some of these things. Secondly, there's quite a situation where there was policy to keep banks running at all costs. I don't see why that's an ethics issue per se. You have fundamentally misconceived notions of bank stability. So because we don't want people to say banks are collapsing, we will give liquidity even when the law is quite clear that insolvent banks are not entitled to liquidity. All of these are policy problems. They are problems with leadership failure. Just doing some ethics training is not going to fix it. We have fundamental leadership problems. And I like the fact that currently there's almost a zero tolerance policy being emerging from the current regime at the Bank of Ghana. I am not happy with the way that they've handled the reports by receivers and administrators.
They haven't made it public.
It's very opaque. They've allowed speculation to run rife. In some instances, they have been less than candid with the truth. And to me, it doesn't suggest that there's been significant improvement from as far as the culture is concerned.
The culture of the central bank, yes. And the way it treats
the public in the way that it treats the rest of us in terms of the information that it puts out. Sometimes they're speaking for both sides of their mouth. Is there criminal culpability? Are investigations at the point where you can make categorical statements about potential criminal?
So are you saying that, for example, the reports by the receiver should have been made available to Parliament?
Absolutely, without doubt. I mean, there should have been advice to the government that this is something that requires parliamentary scrutiny. Secondly, rather than tidbits in the press release, a detailed report cataloging the series of events that led to this cataclysmic failure should have been made available to the media. Thirdly, the way that we've clearly seen what's wrong with the banking sector, leadership failures, people that don't understand risk managing banks, instances where there's complicity at the very top of the Bank of Ghana to ignore willful violations of the law. What has that got to do with a lot of the proposals that they are pushing against, like minimum capitalization, some of the Basel III enforcement? Look, let us be very clear. We have a very simple financial system. Very few banks use any tier 1 capital, any capital whatsoever that is not just equity. So even the additional tier 1 capital, in terms of tax deferred assets and things like that, they don't really apply to our economy. Because in practice, the regulatory capital is almost always pure equity.
Wow.
This is heaven for most central banks around the world to have what we have. It's heaven. Because you don't have the complexity of the financial system. If you want, for instance, to do a valuation of assets, almost all the assets are just basic loans. Very little in terms of complex instruments for you to value. So what is Basel III or Basel II going to do to improve on your performance?
Maybe it will give the international investing community confidence.
It will. But it will be if it indeed we are doing things like taking risk weighting seriously. When you say it's not just the loans you've given, but we have rating systems that connect to actual calculation of the risk attached to the asset. So when you've given loans and you say, okay, someone has given loan to the Ghana Highways Authority. In the Ghana of today, that's an inherently more risky loan than giving a loan to a poultry farmer. So these are the things where we need to see more intellectual innovation around understanding what risk means, what risk weights means, etc. And they need to do that work. But often that's not the case. They say one thing, they do another thing, and they see incoherence.
We'll end it there. On that incoherent note, Bryce Simmons, Vice President of Imani, with his thoughts on the banking sector. Thank you for watching The Point of View. My name is Bernard Avle. Stay with City TV. Good night.
It's engaging, detailed, and loaded with factual and incisive analysis. It's The Big Issue, your preferred Saturday morning news and current affairs analysis program on City TV. Tune in this and every Saturday at 9 a.m. and hear the newsmakers discuss the top issues for the week.
At that time, Charlotte was complete. I'm not defending Charlotte. I'm talking about the way we behave like hypocrites